All right, let's talk a little bit about the monopoly graph, what this information all means and how we use these graphs, and ultimately the questions that you're going to need to be able to understand. So in the last video, I talked about how marginal revenue curve is always going to fall below the demand curve. And again, this is always going to be consistent through oligopoly and monopolistic competition and monopoly. That marginal revenue falls below the demand curve, because in order to sell an additional unit, we have to, or the firm has to lower the price in order to sell it. And some key things here to remember is price is always on the demand curve. Okay, price is always going to happen, right? That's the interaction, or these two relationship between these two variables, price and quantity. Price will always take place on the demand curve. So when you're going here and you're looking for an output level at 8, the price at 8, you go up to the demand curve. At 6, you go up to the demand curve. At 5, you go up to the demand curve to find the price. That's important to remember. So we got a couple other curves and graphs on here. The marginal cost curve. Okay, and if you think about the demand curve as the marginal benefit curve, marginal utility curve, and this is going to say the willingness, or show the willingness that consumers have to purchase a good. Okay, at $10, they're willing to purchase 5, and that is based on their marginal benefit as they purchase a unit. They're not quite as willing as they were before, so their marginal benefit is decreasing, and that's the law of demand. That's a diminishing marginal utility. Well, based on our previous understanding, this marginal cost curve, what do you think that marginal cost curve, if the demand curve is a marginal benefit curve, you can guess that the marginal cost curve is hopefully you guessed it, the supply curve. So if we were looking at a perfectly competitive situation, remember equilibrium, where marginal benefit, right? Marginal benefit equals marginal cost, right? That's our equilibrium point. This is where this market would naturally gravitate towards if it was competitive, perfectly competitive. And remember, our marginal revenue in perfect competition, marginal revenue is equal to demand is equal to price. Would make sense, because remember the golden rule, we'd produce where marginal revenue is equal to marginal cost. And if our marginal cost and our demand curve is equal to marginal revenue, this is the output and this is the price. Market price would be 8. But monopoly is a little different. Okay, the golden rule will still, so how do we find a profit maximizing point in monopoly? The golden rule doesn't change. We go and we find our marginal revenue, and where marginal revenue intersects marginal cost, you can see that point down here. So move that out of the way. So where marginal revenue equals marginal cost, this is profit, right? Profit maximizing. Output. So here's what we are looking at. Marginal revenue intersects marginal cost right down here at this point. That's at an output of 5. So for this firm, they're going to maximize their profits at an output of 5. So output would be 5. Price, remember you got to go up and hit the demand curve now. Price of 10. Right? Price of 10. So our marginal cost and marginal revenue intersect at 5. This is the profit maximizing. Now, how do we know we're making a profit? Well, that's where average total costs come in. And all graphs, or all average total cost curves, are going to fall. They're going to hit a minimum, and then they're going to start to raise. And you think about your marginal cost, and usually marginal cost curves, right, when they are below, okay, think of how averages work. Marginal costs are below your average cost, so your marginal, as you produce more and more units of a good, it's pulling your average down. Once they intersect, okay, and the marginal costs continue to rise, it starts to pull your average cost back up. That's how averages work, right? Below the average pulls your average down, above the average pulls your average up. Where these intersect is going to be your low point. So here's our average total cost curve. So this is the cost we have on average. So if we take our 5 units, okay, we come up and we hit the average total cost curve, we come over, it's at 7. So our average cost per unit is 7. Okay, 5 times 7. So our total cost there is 35. 5 units, average cost of 7 is 35. Now, what did we say? The price that we can sell is 10. So we go up in here and get 10, and our total revenue, so this was 5 output times 7 in price, gives us 35. We still have our 5 in output, but we're getting 10 in total revenue. Okay, so this is our total revenue. This is our total cost. We are earning a profit there of, all right, see, $3 per unit. So here's our average total cost, 7. We go up and we're charging 7. So all this area right in here, okay, this area here is what we would say is our profit. Okay. Now, some problems, you might have a situation where if your average total cost is at a different location, you might have an average total cost curve something like this up here, where now your price is below, okay, the average total cost. Marginal revenue curve hasn't changed, just our average total cost. So now we come up and we hit the average total cost curve, and our average cost per unit was $11, and we're only able to sell it for 10. We look at this area here, and this would be what we would call a loss. All right, so that might change as you have different problems, and we'll get into shutdown and minimizing losses in the short run once we throw in the average variable curve into this. But this gives you a basic idea of how to use this graph.